Whenever people talk about property investments, there are generally two main objectives: capital appreciation and rental income. But today, I'm going to challenge that dream. I'll walk you through three big problems with buying a condo to rent out and explain why, for most of us, rental income often turns out to be an illusion rather than a reliable profit stream. Then, just to be fair, I'll share three reasons why, despite these hurdles, renting out a condo can still be a powerful way to build long-term wealth. First, let's look at the core issue, the elusive positive cash flow. Imagine you purchase a two-bedroom condo and secure a tenant at around $3,500 per month. That's $42,000 in rent every year. It sounds promising, but your mortgage payment will be roughly $3,400 a month, especially if you finance as close to the maximum loan amount as regulations allow. In those early years, you're paying about $1,800 in interest and only $1,600 toward reducing the principal balance. Subtract the entire $3,400 mortgage from the $3,500 rent, and you're left with just $100 each month, barely $1,000 over the entire year. That tiny surplus won't cover common expenses like property repairs, utility top-ups during vacancies, or even decent annual maintenance. On paper, the headline, "Rental covers mortgage," sounds true, but only by ignoring the full loan repayment and the heavy interest burden up front. You're essentially pouring money in every month, hoping that one day the scales tip in your favor. Second, hidden costs stealthily drain your pocket deeper than you expect. Beyond the mortgage, you face at least four additional expense categories. Income tax on rental. Rental income is taxed as part of your total earnings. After deducting allowable interest expenses, you might still owe over 10% of the net rental amount back to the Inland Revenue Authority each year. Non-owner occupied property tax. If you're not living in the unit yourself, you pay a higher property tax rate, often another 12% of the property's annual value. Condo maintenance fees. Monthly conservancy charges can be in the ballpark of $300 to $400, adding up to over $3,600 annually for a typical two-bedroom unit. Agent commissions. Leasing through an agent usually costs the landlord half a month's rent per year of tenancy, easily $1,600 to $1,800 every time you renew your tenant's lease. Combine these with unexpected vacancy gaps, minor repair costs, think broken fans, leaking pipes, appliance replacements, and occasional legal fees to enforce late rent clauses, and that $1,000 profit evaporates. In our example, you're more likely to face a negative cash flow of around $1,600 per month, about $20,000 per year, coming directly out of your own pocket. Third, renting out a condo is far from a set-and-forget passive income stream. Even the most hands-off landlords end up juggling tenant relations, late-night calls about aircon failures, clogged drains, or noisy neighbors. Between tenant turnover, deep cleaning, repainting, fixing wear and tear, and coordinating move-in inspections. Marketing and lease negotiation, creating ads, screening applicants, negotiating deposit amounts and rent terms. Administrative oversight, tracking rent payments, updating your accounting, renewing the insurance and HDB/URA licenses. Vacancies are inevitable. Market cycles, tenant relocations, or economic downturns leave your unit empty for weeks or months, yet you still pay mortgage, taxes, and fees. Even when you outsource property management, you're essentially supervising the manager and approving every invoice or repair decision. So if rental income often leads to negative cash flow, hidden costs relentlessly erode your margins, and the work is never fully hands-off. Why do people still invest in rental condos? Here are three compelling reasons. Benefit number one, forced principal repayment. Every dollar your tenant pays in rent goes first towards your mortgage, and a significant slice of that reduces the principal balance, not just the interest. It's the ultimate pay-yourself-first strategy, because you never feel it hitting your own checkbook. Over time, that automatic equity buildup can exceed tens or even hundreds of thousands of dollars, equivalent to a high-yield savings account turbocharged by leverage. Benefit number two, capital appreciation. Singapore's property market has experienced multi-decade growth, driven by land scarcity, strong immigration, and robust economic fundamentals. If you pick a location near new MRT lines, reputable schools, or major commercial hubs, the resale value of your condo is likely to climb significantly. Hold your property over a 10 to 15 year horizon, and it's not uncommon to see 30 to 50% gains on top of the equity you've built through mortgage repayments. Benefit number three, genuine cash flow. Once the loan is paid off, All those years of tenant-funded mortgage payments culminate in a mortgage-free asset. Once your loan is retired, your biggest expense vanishes. The same $3,500 rent that barely scratched the surface during early years now flows almost entirely into your pocket, minus only minimal maintenance and taxes. That's when your condo transforms into the passive, predictable income stream you envisioned. Buying a condo to rent out isn't the right move for everyone. It requires substantial upfront capital, the stomach to endure negative cash flow in the early years, and a willingness to stay engaged with property management tasks. But for those who can weather the initial cash out periods, benefit from forced equity accumulation, and hold for long-term capital gains, it remains one of the most powerful wealth building strategies available, especially in markets like Singapore with limited land supply. Which path aligns with your goals? A low-maintenance index fund, a leveraged real estate play, or a diversified blend of both? Let me know what you think.